two people get the same phone call on the same January morning. The furnace is dead, and replacing it costs $9,000. For one of them, that call reorganizes the next 2 years. The card comes out, the balance sits there at 22%, and the minimum payment quietly becomes a permanent bill. For the other, it is an errand. Annoying, but an errand. The second person does not necessarily have more money. There really are levels in a financial life, and crossing one really does change how your days feel. But the levels are not where you have been told they are. They are not 10,000, 100,000, and a million. Those are round numbers borrowed from somebody else's life, and they will lie to you in both directions. A real level is the point where one specific disaster loses its power to change your life. There are 5 of them, and each has a shock attached to it. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick, just what the math actually does over time. If that is what you want, hit subscribe. The unit is not dollars, it is years of your own life. Take the money you could actually get your hands on this month, divide it by what a year of your life costs. The answer comes back in years, and that number is your level. This is the only version that works, because a dollar does not mean the same thing to 2 different people. $25,000 is a bit over 8 months to one household and 2 months to another. Diane is 62. She spent 34 years as a dental hygienist in Tulsa. She is single, and her 3-bedroom house has been paid off for years. Her life costs about $36,000 a year, and she has around $430,000 invested. Greg is 55, an engineer in Columbus. He still has a mortgage, 2 cars in the driveway, and a house that costs real money to heat. His life costs about $92,000 a year, and he has around $80,000 invested. Greg earns more than twice what Diane earns, and holds more than twice her money. Hold on to both of them. The first level is the repair. This is 1 month of your life, sitting somewhere you can reach today. For Diane, that is $3,000. For Greg, it is closer to $7,700. Below this line, the ordinary breakages of being alive turn into debt. The transmission goes, or the water heater floods a basement on a Sunday. A dentist looks at a crown and says it cannot wait. None of this is unusual, and that is exactly the problem because it keeps happening. Bankrate ran their emergency savings survey again this year. Fewer than half of Americans, 47%, have the liquidity to cover a $1,000 emergency. 30% would pay it from savings and another 17% from the regular cash flow. A third of the country would go into debt to handle it. That last group turns a routine repair into a balance that compounds against them at credit card rates. That is what makes level 1 different from the 4 above it. Below this line, you are not standing still, you are sliding backward. The same event that cost one person $9,000 costs another person $9,000 plus years of interest. The second level is the layoff. This is 6 months of your life, liquid. Diane needs $18,000. Greg needs $46,000. Everybody has heard the 6-month rule, and almost nobody knows where it comes from. The number that usually gets quoted is the wrong one. The Bureau of Labor Statistics has been reporting a median unemployment spell of around 10 weeks lately, which sounds survivable. But the average is more than twice the median, above 20 weeks. Roughly 1 unemployed person in 5 is still looking after 27 weeks. That gap between the median and the average is the whole story. Most people find work quickly, and a meaningful minority do not, and nobody knows in advance which one they are. Age tilted further. Workers over 55 consistently spend longer out of work than younger ones, which is precisely the group most likely to be watching this. So 6 months is not a comfort number. It is what keeps a bad quarter from becoming a bad decade. A person with 6 months of runway can negotiate, and a person with 3 weeks takes whatever arrives first. The third level is the diagnosis. This is 2 years of your life. Diane needs $72,000, and Greg needs $184,000. 2 years sounds like a strange jump from 6 months. The reason is that this level absorbs 2 shocks that tend to arrive together. The first is the medical bill. In 2026, an ACA plan can make you pay at most $10,600 out of pocket for one person. For a family, the cap is $21,200. Those limits rose about 15% in a single year. And that is only the cap on covered in-network care, which is not the same as everything you get billed for. The second shock is the one almost nobody plans for. A health event does not check the market first. Say the year you need $60,000 happens to be a year the market is down 25%. You are now selling at the bottom to pay a hospital. The money you take out never recovers because it is gone before the rebound. 2 years of cash prevents exactly that. The investments get left alone to recover because the bill comes out of money that was never in the market. Level 4 is the forced exit, and for anyone in their 50s, this is the one that matters most. This is 10 years of your life. Diane needs $360,000. Greg needs $920,000. That number is not paranoid, and here is why. The Employee Benefit Research Institute runs a retirement survey every year. This year's found that 46% of new retirees left work earlier than they had planned. 76% of those early exits happened for reasons the person did not choose. 41% cited a health problem or a disability, up sharply from the year before. Another 35% pointed at their employer, meaning downsizing, closure, or reorganization. The average American retires at 62. The average American plans to retire at 65. That 3-year gap is not a rounding error. It is a hole that has to be filled with cash in the exact stretch before Social Security and Medicare arrive. A separate Urban Institute study found something harder still. More than half of full-time workers in their early 50s eventually get pushed out of a job involuntarily, not laid off and rehired at the same pay. Pushed out, with the replacement job usually paying less. So the plan that half of America is quietly running is to work a few extra years and fix the shortfall at the end. Reality declines to honor that plan for roughly half the people counting on it. Level 4 is what makes that survivable. 10 years of expenses turns a forced exit into a change of plans instead of a collapse. The 5th level is the long life. This is 25 years of your life. Diane needs $900,000. Greg needs $2,300,000. 25 is not a magic number. It comes from Moy and Benjamin's research on withdrawal rates and corresponds to pulling about 4% a year. The risk that disappears here is running out of money before you run out of years. Across those 5 levels, Diane's number and Greg's number were never once the same. By the top, they sat more than $1 million apart. Same ladder, same country, same rules, different denominator. Which brings us back to the two of them. Diane covers about 11.9 years of her life with what she has. Greg covers about 9.6. Diane is standing on level 4. Greg is standing on level 3. Greg has $450,000 more than Diane, and he is a level below her. To cover the same number of years she covers, he would need roughly $1,100,000. That is more than $200,000 beyond what he has built in a far better paying career. Neither of them did anything wrong. Greg is not careless. He built a life that costs $92,000 a year, and every rung on this ladder moved up with it. That is what the round numbers hide. When somebody tells you $1 million is where you are safe, they have quietly assumed your life costs what theirs costs. Run that against the real spread and it gets stark. The Bureau of Labor Statistics puts average household spending at about $78,500 a year. But the bottom fifth of households spend around $35,000, and the top fifth spend around $150,000. Now take that famous $1 million and hand it to each of them. The bottom fifth household covers more than 28 years with it, which is level 5. An average household stretches it under 13 years, landing on level 4. Hand the same million to the top fifth household and it covers under 7, which is level 3. One number, 3 different levels. That is why the round figures fail everybody who repeats them. The rungs are also nothing like evenly spaced, which explains a lot about where people get stuck. Climbing from level 2 to level 3 takes another 1.5 years of expenses. Climbing from 3 to 4 takes 8 more years of expenses. That second climb is more than 5 times longer than the first one. For a household at the national average, the first of those climbs cost about $118,000. The second costs about $1,628,000. The step to level 5 costs another $1.2 million on top. So the ladder gets steeper exactly as it gets higher. People who stall on level 3 usually have not lost discipline. They have arrived at the longest rung in the ladder and are still walking it. There is one more thing this ladder does that a plain net worth number never will. It can demote you while your balance is going up. Go back to Diane. She covers 11.9 years, comfortably on level 4. Let her spending rise from $36,000 a year to about $43,000. She slides down to the top edge of level 3. That is a lifestyle increase of roughly $580 a month. A better car, a bigger house, a few habits that harden into fixed costs. Her portfolio would never fall by a single dollar. Nobody thinks of a nicer car as spending down their savings. On this ladder, it is exactly that, because it permanently raises the number every rung is measured against. There is a second way to be wrong about your level, and it catches even more people. My neighbor Helen is 69, a retired children's librarian. On paper, her net worth is about $240,000, which sounds like a comfortable level 3, but $180,000 of that is the condo she lives in. Her actual portfolio is around $60,000. When Helen's furnace dies, the condo cannot pay for it. Only the $60,000 can. That $9,000 repair is 4% of her net worth, and 15% of the money that can come when she calls it. Helen is not unusual. She is typical. Federal Reserve data shows the primary residence is the single largest asset category on American household balance sheets, worth about $41 trillion. That is more than a quarter of everything households own, ahead of retirement accounts at 15%. 2/3 of American households own a home, and for those owners, the median equity is around $201,000. For a household spending the national average, that is roughly 2.5 years of life. Real money and completely unreachable in an emergency. The same problem shows up inside retirement accounts before age 59.5. Pull $30,000 out of a pre-tax 401k at 52, and the 10% penalty takes $3,000. Federal tax at 22% takes another $6,600. You wanted $30 and you keep about $20,400, which is 68 cents on the dollar. That money is real. It just is not worth what the statement says when you need it in a hurry. Now, I have to be fair to Helen because the honest math also cuts the other way. Helen's life costs about $34,000 a year, and Social Security sends her $16,800 of it. Her portfolio is not being asked to cover $34,000 a year. It only has to cover the whole, which is about $17,200. So count Helen 3 ways. On paper, she is level 3. Counting only reachable money against her full spending, she drops to level 2. Counting reachable money against the actual whole, she climbs back to level 3. 2 corrections pointing in opposite directions, and they roughly cancel. That is what an honest answer usually looks like. It is rarely as bad as the pessimistic version or as good as the flattering one. Helen is genuinely fine, and she is also one broken furnace away from an uncomfortable year. Both of those are true at once. Put those 2 corrections together and you can sketch where the typical household actually stands. The median American age 45 to 54 has a net worth around $247,000. For homeowners, median equity in the house runs about $201,000. These are medians of 2 different things, so they do not subtract cleanly. Treat it as a sketch rather than a precise answer. But the direction is hard to argue with. Counted the usual way, that household looks like a comfortable level 3. Counted by what it could actually reach in an emergency, it lands on level 2. A whole generation in its peak earning years is one level lower than its own net worth statement suggests. Not because anyone lied to them, because the number they were handed measures the wrong thing. A ladder like this is easy to misuse in 3 specific ways. The first misuse is treating your level as a verdict on you. It is not. It measures one thing, which is how hard a shock has to hit before it changes your life. Someone on level 2 at 31 with a rising income is in a completely different position from someone on level 2 at 64. The latter knows nothing about your age or what is coming. The second misuse is deciding home equity is worthless because it failed the furnace test. Your house is real money, and it is the largest asset most American families will ever own. At the top of the ladder it counts fully, because selling or downsizing is a legitimate way to fund a long retirement. It is simply the wrong tool for the bottom 2 rungs, since a house cannot be sold over a weekend to pay a hospital. The third misuse is the one I want to be careful about. The tempting conclusion from all this is to shrink your life. And a smaller denominator does lift you a level without earning a dollar. That is true, and it is also a limited tool. Somebody whose expenses are already at the floor cannot cut their way to level 4. For most people below level 3, The honest answer is still the boring one, which is more income and more saving. Diane's edge over Greg came from 34 years of a paid-off house, not from a month of skipped restaurants. Add up the money you could actually reach this month without a realtor, a penalty, or a tax bill. Count retirement accounts fully if you are past 59 and a half. If you are not, count them at about 70 cents on the dollar, then write down what a year of your life honestly costs, not your budget. What actually left your accounts over the last 12 months? Divide the first number by the second. If you are already retired, divide by the whole instead, meaning your spending minus whatever Social Security and any pension reliably sends you. Whatever comes back is your level. Under half a year puts you at 1. Half a year to 2 years is level 2. 2 to 10 is level 3. 10 to 25 is level 4. And past 25 is level 5. Almost nobody has run that number, which is strange. It is the single most informative number in a financial life, and it takes about 4 minutes. What this ladder measures is not wealth. It is the size of the surprise that can still knock you over. That is why the levels feel so different from the inside. Nothing about your personality changes when you cross one. What changes is the category of bad news that now arrives as an inconvenience instead of an emergency. First, the furnace stops being a crisis, then a layoff, and eventually the year your employer decides they are finished with you. Nobody sends you a letter when you cross one, there is no notification and no phone call. You find out the next time something breaks by how you feel when you read the estimate. Run your number tonight. Then look at the shock sitting one rung above you and decide whether you would rather meet it as an inconvenience or as an emergency. If this was worth your time, hit subscribe. I will see you in the next one.